So as of last night, the government has shut down. What does this mean for your investment accounts? I'm sitting here with Matt Rice. He's our Chief Investment Officer. He's also a chartered financial analyst. Matt, what are your thoughts on government shutdown? Should people sell everything they own because doom and gloom is here?
Well, thanks for the intro, Anthony. No, the short answer is no, people shouldn't panic. We go through these kinds of things every few years. I feel like recently Congress has had more of these kind of standstills where they've kind of put up pitchforks and kind of come together and fought. But, you know, at the end of the day, these kind of things tend to work out. We tend to have a few days of volatility, and it kind of becomes old news rather quickly.
Well, Matt, if I recall, it was 2018-19, there was a government shutdown, and within a matter of 35 days, we were fired back up. But it's not like the world imploded in those 30 days.
That's right. There can be some challenges, like, you know, government data may come out a little bit slower. You may have issues getting your passports updated. But generally what happens over time is that these two sides politically go to war with one another thinking they're winning the political war, and then they both realize they're losing, and ultimately they come out and they put the government back to work.
Exactly. And I think one of the things I read is that it cost the economy around $11 billion during that 35-day stretch, but a lot of that was attributed to the people not having the additional income, so they weren't putting it back into the economy. But you and I were just talking about that. It's almost like a rubber band. Yeah, it got stretched thinly during that period of time, but as soon as they got their income generated back up, that spending comes right back, even making up from what they weren't spending.
Yeah, absolutely. The economy kind of has a natural growth rate associated, and when something comes in and kind of disrupts it a little bit and it gets artificially slow or artificially fast, there's bumpers and guardrails in that kind of slow it down when it's moving too fast, and then allow it to kind of accelerate after a period of slowdown. And even during recessions, like there's this period of negative growth, sometimes as we call it, we used to call that shrinking.
Sure.
Negative growth, that there'll be a catch up in demand as people kind of go a while without spending, and that's kind of the net. It's to a certain extent healthy for the economy to have to go through those periods of ebbs and flows.
Well, even if it goes down, that does create new buying opportunities. And in fact, again, shut down last night. As of today, we're green for the day. So I guess the net takeaway from this is just because there's a government shutdown, don't panic, right? If you have a well-created investment plan, retirement plan, which we do for our clients, you should be insulated from this and not have the knee-jerk reaction to panic and worry.
Absolutely, Anthony. And the Goldstone Financial Group, our rebalancing process is simply that when things go haywire, like they did maybe in the early parts of the pandemic in 2020, when everybody's afraid, those are the best buying opportunities, and that's what our system does. It forces us to rebalance in those difficult periods when it doesn't feel right to do that. And it was very similar during the April sell-off that we had this year when President Trump announced the tariffs. The same process, the discipline, those became great buying opportunities. And I remember as far back as 2009, coming out of the financial crisis, we went to clients and we're like, you should rebalance now. Everyone looked at us like we had a third eye. And sure enough, all those human beings are kind of hardwired to lose money.
Sure.
And that's why we build these disciplined systems at Goldstone Financial Group, is to offset those natural human tendencies that we have to be, we should oftentimes when people are selling, that's when you should be buying, and vice versa.
Sure.
And that's why we design the systems the way we do.
I totally agree, and I think fear of loss can get people to make moves quicker than gain, right? When they're gaining, it's one thing, but fear of losing is where people make those knee-jerk reactions. And yourself, you, past life, right? You were the chief investment officer with the firm. You were responsible for seeing almost $300 billion of assets, so that comes with a lot of responsibility. You have a tremendous amount of knowledge over the years. So again, with what's happening out there now, from your experience, this is not something to, panic about.
Not at all. And I've written a couple books on investing, and probably the most interesting chapters are the behavioral finance chapters, because it's funny because a lot of financial theory is predicated that human beings are these rational animals that make decisions rationally, and we're not. It's the behavioral finance side. It's these little quirks that we have, these mental shortcuts that we have built into our psychology that actually is how which actually drives markets.
Sure.
Fear and greed is kind of the summary of it. It's a little bit more complicated than that, but at the end of the day, it's the human psychology drives markets as much as anything, mathematical.
Sure.
So, and it's funny, the University of Chicago here and nearby is the home bed of modern portfolio theory, but it's also the home base of behavioral finance. So, it's funny to see those two sides, those two factions go at one another.
Yeah, absolutely. Well, hey, we're happy to have you at our investment helm here with Goldstone, and appreciate the time sitting down.
Thanks, Anthony.
Yeah, sure.